Good afternoon, ladies and gentlemen. Happy Friday, October 30th, 2020 to you all. Of course, we're going to have a little fun with sort of today's graphics. Why not, right? Might as well have a little bit of fun. The market has been a little bit tenuous the past couple of days. But in any case, welcome to our Power Options Open Forum Q&A session today. We've seen a part of the EAP, that big decline on Wednesday, tried to see a little bit of climb back on Thursday, and then the tech earnings sort of took over and some other things took over today as well. So we saw some other little pullback there. The market hit a bottom at around 1 or 2 o'clock, maybe a little bit before, and then it tried to come back a little bit afterwards, but still down for the day, down for the week, down for the month as well. A disastrous Wednesday that took us on. Well, before we begin, we always want to start off with what is Power Options. Power Options, of course, is a patented suite of options trading tools for self-directed options investors. Using our tools, you can search across the universe of options to find only those positions that match your personal risk-reward tolerance in a given strategy. In each strategy, you can search by up to 15 to 20 different option criteria, from 20 to 25 different stock criteria as well, screen against your own personal stock lists, and much more. There are quick links to further research and analyze the stock or the option. You can also compare different strategies, evaluate risks, what-if scenarios, and of course, take a look at the parity trade for most positions as well. In addition to that, we do offer a powerful set of portfolio tools that will help you track and manage your positions, of course, and evaluate rollout opportunities as well. All right, so our process and procedure. When you logged on to the webinar, the GoToMeeting, GoToWebinar platform appeared on your screen. Inside that platform is a question pod. Use that pod to send us a question at any time during the presentation. Whether you have questions about general option strategy, questions about managing or adjusting positions, option specifics, if you want to know what is gamma, what is theta, what is vega, or even if you have questions about the options basics, what is in the money, what is out of the money, what's a good structure for a long call, that's all fair game. Of course, you may have questions about the tools on Power Options, setting up a search, evaluating the portfolio or more, or concepts of the limited risk radioactive trading. I think our second or third position question, that came in was related to the radioactive trading technique. I think that's from Medio. We've got a couple questions from William and others before that as well. Now, our basic ground rules. Don't be shy. Please feel free to ask any questions at any time during the presentation. Be patient. There may be 1 or 2 questions ahead of yours, but we'll handle all questions that come in. We don't ignore any questions. We don't push off any questions as well. We're scheduled to be here from 4:30 to 5:30 p.m., but if we have a high volume of questions, we'll be more than happy to stay online to make sure all questions are handled. Also in that question pod, feel free to help us help others. If a question comes in and I give a response based on my market experience, things I've done in my personal account, conversations I've had with Ernie, of course, the president and founder of Power Options, or other investors, but you have a different way of evaluating a strategy, a different criteria you like to look for when searching for a specific position or specific strategy, use the question pod to share that with us. Of course, I may ask you for clarification on your question. There are a lot of terms that are out there. There's a lot of different structures that can be used for a given position. So I want to make sure we have everything right and in the proper structure before we start going into your discussion. Before we get to the main question, William just popped in after his general question. He popped in. He says, Power Option Clients wants to know if Michael's kids helped with the graphics. No, this is something I put together on my own, although the wife, of course, and the kids helped to put together the different screenshots that you're seeing there, and Kip as well. So most of these screenshots that you're seeing, aside from the bats and the cats and everything like that, are just basically from our house as well, decorating our house for Halloween as well, because the kids have a lot of fun with it, so we always decorate that as well. All right, all of that being said, let's get down to it, ladies and gentlemen. I'm sure we have a lot to cover. There's a couple things I'd like to share with you, questions that came in during this week as well. But you all have some great questions that have already come in, and we're going to start directly with William here. Let me just make sure. All right, so what we're looking at here is the Power Options suite of tools for a trial member. Those of you that are just getting started on your 14-day free trial, I'm going to encourage you to take advantage of the 4 steps that are listed here. Free quick start guide, access the flash tutorials. There's a variety of archived webinars that you can view. You can also check those out underneath the main home tab in the free webinars section. And of course, remember, any trial member or subscriber can schedule a free coaching session at any time. That's essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. All right, I didn't check the attendees, so I'm going to do that real quick right now, William, before I get to your question. Sorry if anything pops up here. Let me move this over. Okay. Okay, good. All right. Well, not good, bad, but Sam is not here yet. I don't know if he's joining us this afternoon. The reason why I bring that up is because William's first question for today is, good afternoon. Could you elaborate on how you trade UVXY? UVXY is a volatility ETF. So it measures volatility in the market, as is VXX is a certain type of exchange traded note. The benefit that Sam has always pointed out to me, he's one of our regular attendees, is that unlike the VIX, unlike the VIX, which measures volatility, of course, and you can trade options against the VIX, we're all pretty much familiar with the VIX as well, but it more along lines measures the future outlook for volatility. UVXY and VXX are ETFs and ETNs. So if you're in an option strategy and something goes against you, you have the ability to buy shares of the underlying or short shares of the underlying to maybe help with a repair or help with a movement. With VIX, you can't do that. VIX is a straightforward index that doesn't have available shares to purchase or to short. Okay. So the question is, William says, how you trade UVXY, specifically, what type of option strategy do you use? How far out in time do you go? What strikes in the money, at the money, and out of the money? An exit strategy when the trade goes in your favor or when it doesn't. Thank you. All right. Well, this is an excellent question, William. And I'm going to let you down and sort of depress you first. And then we're going to go ahead and talk about how I would normally approach this as well. What I generally use UVXY for and the VIX, and I'll buy calls on the VIX when the VIX is lower and relatively affordable. And it is designed to be a hedge against the leveraged portion of my portfolio. In other words, many of you have heard me say that in general, 50% of my portfolio is in married put positions. The limited risk positions, we're going to get to that question in a moment, I believe, for media. So I don't really worry about protecting these positions, the married put structures, because at most I can lose is 4, 5, or 6%. What the VIX or the UVXY or the VXX is used for is to protect, things such as bull put credit spreads, calendar spreads, the leverage portion of my portfolio, which can lose up to 100% of the maximum risk in a market downturn. Now, William, I don't have an options plan for UVXY. This is something that Sam turned me on to. Back in February 2018, 2019, I'm just going to go back here to the main screen and pick this up. You're not seeing it right now. I'm just going to turn this off. Anyway, when the VIX was low during that run, remember we had of SPY starting in January 2018 after a light bottom, and it started to just run up, and we were hitting the highs on January 30th and on February 1st. What I was doing at that time was buying 30 to 45 day out call options on the VIX. Okay, so let me go. I know you're not seeing it yet. Let me just get there so it's easier to see, hopefully. Okay. All right, fantastic. We back there to big charts. Yeah, and I might clean this up a little bit. Okay. So what you're seeing here, of course, is that extraordinarily high run that we had in March of this year. But if we go back a couple years, and that's what I have here, that other peak that happened was right around February of 2018. What this was, remember, is that this was a good movement up in January. February 5th through 9th was this peak where it went up from 10 or 11 to about 50. This was that first moment, William, of the trade tariffs, China trade war, China trade tariff that was discussed, and it caused a big panic in the market and a large spike. The VIX was down near 11, and we see a little while ago, right before that long run into March, right near January and February, we were going back to that 10 or 11 range. Why is this important? Usually, if the VIX is below 14 or if it's below 15, less than, 14 or 15 or so, what I typically would do is go 30 to 45 days out and buy out of the money calls on the VIX, which had a delta of around 0.3. Or, no scientific explanation for this, William, either a delta of 0.3, not lower, I wasn't going to 0.2 or 0.1, but around 0.3, whichever one was closest. But it didn't have to have a certain probability to be a certain range out of the money. I also wanted to look for the option that was also closest to $1 in premium. Then what I would do is take somewhere between maybe 2 to 4% of my total portfolio value and buy X amount of calls on the VIX to plan for the unexpected, the little spikes we kept seeing over and over during 2018, sometimes into 2019 as well. And that was strictly designed to hedge. Oh, Sam did just show up. I'm sorry. That was simply designed to hedge against the unexpected. Only putting in a few $100s, maybe 500, 600, maybe 800, depending on market conditions and where we were. But that's essentially what I was looking for. Even after the pullback in March, when the VIX was still around 30, we were still around 28, we went back up to 45, we went in this range. The VIX calls were too expensive. Everywhere after March, the VIX calls were too expensive. These worked out well for me. I was still doing VIX calls at that point. This worked extraordinarily well for me. February 5th through 9th, I had 3 bull put credit spreads that I had to close the day that happened because they all hit my target of a 45% loss. Another reason why I only trade the bull put credit spreads with about 15% of my portfolio, because that only drew the whole portfolio down 7%. But I bought them in January for the late February expiration when the VIX was at 11. I was holding 16 strike calls. So this run up actually countered the loss on the bull put spreads and led it to a profit if you combined all of them together. That's how I'd play the VIX. But in this time frame, the VIX is too expensive. So what I'm doing in that situation now, William, is I'm buying straight shares of UVXY because the VIX calls for me were too expensive. I'm sorry, I'm going to go back radioactive. That's where I was tracking it there. So around late September, early October, I got into the VIX a little bit too, UVXY, William, a little bit too early. I bought in around $22, $23. Well, that doesn't look bad with the VIX at 21.58 right now. But what had happened? As Sam had mentioned before, and I'm going to get to Sam's comment related to this in a moment. So right around, I did buy some right around here, but I sold them here, and then I got back into them around here. And then UVXY went down here. So what am I? I'm essentially long stock at 21 that is now trading at 16. So I have to manage it. So instead of using this as a hedge now for my portfolio, I did a couple of things. I averaged down, and then I used that ratio stock repair on this position to sort of get back to break even on the UVXY shares. What did that do? That did cap the gain on the first half of the shares with the recent jump up in UVXY. Thankfully, I left about 75 shares open, so that still hedged some of the loss that I might have taken on the bull puts this week. But I was okay with sort of capping the gain with the stock repair on the UVXY shares because, as you've heard me say, I did not have any bull put spreads open. The 26th on Monday was, William, going to be my next cycle to open bull put credit spreads, as I normally do, those 2-week out spreads. But because of the election coming up between now and the 6th of November expiration, if I had opened them on Monday, because of a lot of the earnings that were coming up, not in the bull puts I would have traded, but the earnings in general that we saw yesterday, all the big FANG stocks and everything else, it wasn't worth it to me to enter a vertical spread that could take 100% loss with the unexpected. So I stepped out of cycle. I'm not trading bull puts again until after November 6th, maybe November 9th. We'll see what the market is doing. So that's essentially how I play UVXY. I play it as a stock position, and if I have to repair it, I will. But on VIX, when it's affordable, I will just buy calls on the VIX. I'm not interested in trying to do bear call spreads on the VIX now that it's hit a peak, and I don't want to buy the puts after the run because I found they're too expensive. Could I buy puts on UVXY after a sudden volatility? Of course I could. But it's harder to play. It's harder to track. Sam's comment here was that I did not play UVXY. I felt not enough move on it, but you have 340 puts in SPY. So that's another approach to play the downside of the market to hedge a leveraged portion of your portfolio or for profits. Sam decided that with the lack of movement we've seen recently in UVXY, especially when I got in at the wrong time, and then I had to deal with managing it, but now it's gotten to a spike. Sam feels that it didn't move enough. But he's been using 340 puts in SPY every day, trying to open up the top gains. You're in an Apple straddle plus a collar trade, you mentioned as well. Sam also likes to use sort of the inverse ETFs. He mentions FAZ, SRTY, and SQQQ, sort of the ultra short or the ultra inverse ETFs. Sam also says he's no bull puts now. He's only in bear calls on IWM and SPY. I haven't opened any spreads because I didn't want to take a chance that there could be a sudden spike in movement for really great earnings on the FANG stocks last night. I'm not as confident in my chart reading as Sam feels he is, of course, as well. And Sam says those contra ETFs are 18% gains. Now, I don't know if you mean just this week, Sam, or if you mean over the course of how you've been trading them for the past few weeks. Or months, I should say, as well, because you stopped trading UVXY, I believe, a couple months ago. 2 weeks. Okay, so he's up 18% on his inverse ETFs, the contra ETFs that he mentioned, SQQ, FAZ, and some of the other ones as well. So in general, let's just go back. Well, I'm just going to go here. Those are some of the ideas, William, of how I approach using portfolio insurance with broad-based ETFs, volatility ETFs, and there is something, as Sam says, to be used with the contra ETFs, the short or the ultra short ETFs in a bearish market. If the VIX is low, if it's below 15 and the calls aren't expensive, we'll take a look at a chain in a moment. I like to use VIX calls 30 to 45 days out, looking at about a 0.3 delta just in case. And I'm applying 2 to 3% of my portfolio. When the VIX calls are too expensive, the volatility of the volatility ETF is too expensive, I'm going to be looking at UVXY, just shares of UVXY. And if I timed it wrong, I may use options to manage it. But I'm not using calls on UVXY or puts on UVXY. As Sam mentioned, it doesn't move, it seems, as much as the VIX, where the calls get that really big bang to help hedge the leverage portion of your portfolio that might be down 50, 60, or 70%. VXX is an ETN. It's another one that's very useful. Sam has had extreme luck and extreme great timing, the way he times his trades, with those inverse ETFs, the contra ETFs. You mentioned SQQ, FAZ, and others as well. And in general, I've heard Sam mention that he might trade an option against those to get premium to lower the cost base if he feels it's neutral at times. But the one thing you don't necessarily want to do with a hedge. What don't I necessarily want to do with a hedge? Well, exactly what I said I did. Okay, so for example, if I had UVXY, I'm going to go to a stock repair, William, very quickly. Let's say I bought UVXY at 24, complete wrong timing, and I had 100 shares. And UVXY is dropping down to 21 now. It's down at 22. I might use a stock repair. I don't want to use a 21.5 strike. I prefer an even, but it's going to force me to do that. So I'm going to use one of these. Here's 21.33, looks like the lowest, and it's still in November. Okay, so I'm going to use this November repair where I get about a 285 net credit just between the, that doesn't sound right, 50-cent strike differences here. That really doesn't sound right. Oh, no, it does. It does. Okay, so let's go to Analyze Trade. For the repair in this case, what am I going to do? I'm going to buy one call, of course, at 21.50 for 385 and sell two November 22s at 335. Now, I had mentioned last week, I believe, that if the stock stayed above 21.26 or something, that my repair would have worked. And it did, but I had an extra 75 shares open that I sold most of the other day. Okay, but see, here's a repair. I'm sorry, let me get that full screen, folks. I apologize. So what does this do? This gives me a nice net credit. I'm essentially doing a covered call, selling one call against my 100 shares of UVXY, and then I've got a bull call debit spread of a 50 strike difference. But I'm doing this at a net credit because I'm selling two and buying one. Nothing's naked, but it does cap the upside. Why is this a dangerous play? Or why would be selling a call, a covered call against UVXY if it's down below where I want to, a dangerous play? Because if the market had turned worse, I know it was terrible, but if the market had turned worse and UVXY had gone up to 30, that might have been another 900, 1,000 point drop in the Dow, or, you know, a bigger drop than we saw on Thursday, continuing the next 2 days. And so those bull puts or those leverage portions or even some of my married puts would all be near maximum loss. And I capped the gain. I didn't let my portfolio insurance, I didn't let my hedge run. So that's some of the danger of trying to treat your portfolio hedge as a need to get to break even, because if you start selling calls against the shares of UVXY because it was more affordable than VIX calls, or even the inverse ETFs, the contra ETFs that Sam mentions, they can turn you quickly where the hedge that you were using has a capped gain and it's not doing what you want. This does bring me to a quick point. The other day, I had a phone call from a gentleman who's got about $500,000 portfolio. Most of it's invested in SPY. And he asked me that he figured out a potential hedge that he could use for his portfolio. So if SPY dropped 20%, he'd be down $100,000. He wanted to hedge some of that. So what he did in that case is he created a bear put debit spread on SPY. And I think he was out to November. He was out to December, but I don't think it was the full expiration. We'll go to December 18th. And if memory serves correctly, at the time the stock was in the, I'm sorry, SPY, pretty close to where it was. He bought a 329 and he sold a 299 or a 295. I'll just use a 295. It's a wide bear put debit spread. Now, I'm just going through this example real quick. So his idea was if the stock fell down to 266, he's going to have a large return on this position. His 329 put's going to go up to about 60 points of intrinsic value. Well, he's absolutely right. Okay, so this drops down to 329. I'm sorry, this drops down to 266. This is roughly 63 points in the money, and with still some time to go. So this is going to be around $60 or more. But what he missed is he's trying to hedge the cost here by selling the 295 put. Well, if his anticipation was a 20% drop and it fell down to 266, yes, this one's going to go up to about 60 points, about a 50-point gain. But this one's going to go up about 30 points because he's 30 points in the money on the 295 put. He capped the hedge on the position to save cost. It wasn't going to give him back what he was really looking for in that scenario. So I ran the examples with him, of course. This went down to 266. It does serve, let's say, I'm sorry, let's just go to November expiration. After the election, after a few more earnings come out, let's say it happens a month before. So in this case, yeah, we went up to about 6,300, gained $4,046, excuse me, on his long put. But he's giving back 2,500 because he's not at expiration yet, and this put is 30 points in the money. It wasn't the hedge he wanted. It capped it to only a short amount of $2,000. But he wanted the lower cost basis because, yeah, it's really expensive to buy 30 December 329 puts to hedge the $500,000 portfolio. So that's one of the reasons why it's dangerous to try to treat the hedge like an actual trade and try to manage it to get back to break even like I did on my UVXY, honestly, when it's not going in your desired direction, because when you least expect it, it will. Okay, so that's just some of the concepts there. And that's how I trade UVXY, how I would like to trade the VIX. But let's see here. VIX, of course, popped. It's up to 3802. We've seen it run significantly. Let's just take a look here on big charts. Yeah, so it was still in the 24, 27 range, and then it went up really high up in the 40s. It's right now at about 38. But even back here, the 32 and 33 positions were really expensive. And the other trick with the VIX, something that didn't bother me before, because when it had that big move, it worked out really well. But a problem again with the VIX, something different than the VIX, is that it doesn't necessarily act like a regular option. What I mean by that is that if the VIX could shoot up 5 points, and I could be, let's say I'm holding the 35 and it goes up to 40, my 35 call might not be worth 5 points. It might not be what you expected intrinsic value, because the prices of the VIX calls are based on the future indexes and the futures of the volatility, not necessarily an intrinsic value of the underlying where it is right now. That is a little tricky for some to get through, and sometimes that can happen from time to time. So let's just go to the chain real quick, and I'll show you what I mean. What I would normally look for, and I think it's a little bit too expensive, for an addition that, yes, I'm going to put the same amount, 2 to 3% of my portfolio. Let's go to December 1st, 32 days out. Let's just look at the calls. And the 0.3 delta is not even showing. I got to go to the large chain. A lot of strikes. There we go. The 0.3 or 0.34 delta is the 55 strike with no bid, but a midpoint of about 284. That's almost triple of the price I usually want to pay, multiple contracts. Now, sure, I could cut it down just by 1 or 2 contracts here at 284, but that's the 55 strike. Do I expect by Monday or Tuesday before the election that the volatility is going to be pushed up another 17 points from 38 to 55? No, this doesn't look like the right play to me to track the unexpected. I could be wrong. We could see it go back up to 60 or 70, but I don't know. Okay, and back to the conversation we were talking about with William. I'm sorry, we were talking about there. One last little thing here. Where was I? See? Okay, let me go back to SPY. Oh, do I still have it? No, I don't. Sorry, folks. I just want to take this off and take this off. In any case, William says, real quick follow-up. For the guy with a 500K portfolio, what about a laddered approach using SPY put debit spreads? A third for a 10% down move, a third for 15, a third for 20 down move. Thoughts? My thoughts are, William, is that when the decline happens, it usually happens more than you expect. Sorry, folks. Usually happens more than you expect and faster than you expect. I don't want to cap my hedge. Yeah, the debit spread is going to lower the cost of just buying the puts, but if the decline I'm looking for exceeds my worst fears and it happens faster, I don't want to have a capped gain, whether it's 10% down and then another third at 15 and another third at 20. I'd just rather leave it open. And honestly, you get what you pay for with insurance. If you look for a cheap way to have insurance on a position, then you sort of get what you pay for. And that's what my hesitation is with trying to use debit spreads, ratio back spreads, which can work okay. But I'd prefer to just have a hedge for that leverage portion of my portfolio with an open-ended view rather than trying to cap it by having a lower cost by selling another option, selling a lower put, or doing a bear call credit spread on it that has a capped gain. I'd rather leave it open. All right, so that's where I'm going to end the conversation here. Let me just take a look to see if Sam has any additional comments. That's the concepts of sort of portfolio hedging. Stock or portfolio insurance is what we call it. Is it better to insure your positions directly or insure the portfolio? And I've been using these portfolio hedges, these volatility ETFs, contra ETFs sometimes, as Sam mentions, but volatility ETFs or VIX calls when the VIX is priced right, to hedge that leverage portion of my portfolio. Long calls, calendar spreads, bull put credit spreads, in case something happens that is beyond my control, like I saw February 5th through 9th, 2018, February 25th to March 20th of this year, and many other times in between. Samba's comment says, I realized I overtraded in puts when I trimmed them to my trading plan. Not to overtrade, I had to sell some puts away anyway so that they all made money. There's a risk of overtrading. It's Twitter puts. You've got the really big move on. You had 275 puts on Facebook. Facebook lost 17 points. Yeah, Twitter lost that big drop as well. And he said, this pullback, I was not in UVXY. I was concentrating in the tech stocks, was hedging with SPY and IWM. I started buying the puts last week, Thursday, on the tech stocks as well, and got out of those positions. Okay, great. So that's just some of the topics on the stock or portfolio insurance, how I attempt to use UVXY, the VIX, to hedge against the leverage portion of my portfolio.